All right. Well, thanks everyone for joining us. This panel is climate change, climate risk, and the Federal Reserve, why the Fed must take action. And I'm your moderator. My name is David Arkish. I am with the Roosevelt Institute and Public Citizen. I'm a fellow at Roosevelt, run the climate program at Public Citizen. And please join me in welcoming Tracy Lewis and Alexis Goldstein. Tracy Lewis is the Senior Climate Finance Policy Advisor at Public Citizen, where she works at the intersection of climate finance and financial regulatory policy. She is also a member of the Climate and Community Project based at the University of Pennsylvania, where her work will focus on the Red, Black, and Green New Deal in the Gulf South. Tracy is a proud alumna of Spelman College and Vermont Law School. And prior to working as a policy director in the Maryland General Assembly, her prior work includes being a policy director in the Maryland General Assembly, a labor representative for NEA and AFT locals. She was also in the federal service at the Securities and Exchange Commission and the Department of Justice. Alexis Goldstein is the financial policy director for Open Markets. She is also a financial regulatory expert and former Wall Street professional. Alexis previously worked on financial regulatory policy, consumer climate finance, consumer and investor protection, and higher education for Americans for Financial Reform. And Alexis is an advisory board member for the Project on Predatory Student Lending at Harvard Law School. All right. Well, thanks again for joining us, Tracy and Alexis, and thank you all for to our audience. Let's start at the beginning. This panel might strike a lot of people as weird. What does the Federal Reserve have to do with the climate crisis? Alexis, you want to take this one?
Sure, and apologies, I didn't realize I wasn't muted, so hopefully I wasn't too noisy. So the Fed, I think, when people think about the Federal Reserve, I think they most often think of their responsibilities to set monetary policy, but that is not the only thing the Fed is responsible for doing. They are also responsible for overseeing financial stability and making sure that they maximize employment and keep prices stable, in addition to what I think people normally think of when they think about the Fed, which is their interest rate responsibilities in maintaining moderate interest rates. And so when we think about the stability of the financial system, there are a lot of things that might impact that. Obviously, financial crises like the one in 2008 has a big impact on the financial system, but climate change and climate risk in particular, both to all of us collectively, to the banks that the Fed oversees as a regulator, and to the economy itself, is a very important part of financial stability. And so the Fed is very much, you might have heard a lot of debate from Republicans about, oh, maybe the Fed is overstepping. It is very much within the Fed's mission and its core mission to make sure that there aren't financial stability concerns. And I think we'll talk about this more, I'm sure, today, but I think climate change and climate risk is a very clear and present danger to the stability of the financial system. And that is very much part of the Fed's mission to manage.
Got it. Thanks. And I'm going to pause for a second because I made a mistake up front. I forgot to tell our participants about Q&A. Please do ask questions. I think we will probably get to them at the end, but don't hesitate to stick one in the chat if you have it. And if we can manage it on the tech side and see them coming in, maybe we'll even take them in real time. But we may just take sort of a stack of questions at the end. So don't hesitate to put your questions in the attendee chat. Thanks again. Okay, so we've got climate. The sort of our main focus here, I guess, is going to be on climate and the Federal Reserve's financial stability mission and its job of regulating the banks. But as you said, it also has this job of doing monetary policy. I think it also has, obviously, a responsibility to promote economic development, I think in particular for communities of color. Tracy, did you want to speak to either of those missions at all before we move on?
Oh, certainly. Alexis laid out some of the wrinkles that people see, detractors see in the push by progressive orgs to make the Fed recognize that climate change represents an existential risk not only to our existence but also to our financial systems. So and one of those incredible threats also, of course, is to frontline communities and communities of color in specifically, and those financial risks really incorporate a host of wrongs that have been done to these communities, and should they be hit by another climate event, they typically do not have the same financial wherewithal as white communities. So from insurance, from car ownership, from having bank accounts. I know those aren't things that are specifically in the province of the Fed, but those are some characteristics that make it more difficult for Black, Brown, Indigenous folks to have that necessary financial cushion and infrastructure in their lives, which is one of the reasons, which has been caused by um, caused by racism. So if there's no banks in your neighborhood, it's likely that you may not have a bank account. And if you don't have a bank account, are you eligible to borrow? Or will you be able to buy a home, etc.? So that's why we have the Community Reinvestment Act, for example. So just as Congress mandated the Fed to recognize these systemic harms in communities of color, it needs to do the same in terms of climate risk and build out an infrastructure that will prepare all of our communities and make them more prepared and resilient against these known climate event risks that are coming. I hope I answered that question in a really long, roundabout way.
That was great, thanks. And I mean, it's clear the links between, I mean, not only that the Fed has this other mission of economic development, and particularly in marginalized communities, but that there are really tight links between that and climate and its climate mission. And I should say, I have sort of planned out in advance who I'm going to ask questions to, but feel free to jump in anytime or note if either one of you wants to get a word in on anything. I'm happy for this to be as informal as possible, and more of a conversation. But just for planning purposes, I have to pick somebody to ask things to. And so actually, my next question I do have actually listed as directed to you, Tracy. But as Alexis mentioned, climate change poses huge risks, right, to banks and the financial system. And in the abstract, that seems obvious, right, because climate change threatens everything. It is an existential threat. Wonder if you could expand on that a little bit in terms of what it means to say that it threatens the banks or the financial system in terms of the way the Fed would look at that issue.
Sure, I'll touch on a couple. So we have transition risks. So if folks who are watching aren't familiar with the IEA report from earlier this year that declared that all nations must cease any further fossil fuel development, the building of infrastructure, no more offshore drilling, in order for us to reach, I don't want to use net zero, but I'm saying net zero, to meet our, no carbon emissions by 2050 at the latest. So knowing this, just for example, so the transition risks that are represented by not moving is that especially the United States, we know that other nations are making these moves. So if we delay the implementation of reducing fossil fuel investment in fossil fuel infrastructure, when it will have to happen, we'll suddenly be facing a huge crisis in total disinvestment in fossil fuels in a very rapid period of time, which could have incredible negative effects on our economy. So, for example, if we continue investing in coal, and in 2040, every other nation has stopped investing, we have nowhere to sell it, then what happens to the coal plants? What happens to the people who work in these places? What happens to the towns and cities where people do this work? So that sudden disinvestment is a transition risk, for example. Yeah, I'll just stop there for that example.
Appreciate that. So transition risks, so the risks that are involved in the transition to a clean energy economy. It does seem like when markets move, they don't always move slowly or in a way that's orderly. Instead, sometimes there are very sudden transformative moments where all of a sudden everybody wants to sell something, right? And I think that's what we're talking about here with fossil fuels, right? That the possibility that, and related industries, right? The possibility that all of a sudden their value just craters in their fire sales. And it does seem like fairly obvious that could pose risks to particular banks or other financial institutions that are too entangled with fossil fuels, or to the financial system as a whole.
Yeah, you know what? And I want to add one other thing that's representing that transition risk, of course, is as you noted with a fire sale possibility, that leaves a likely scenario of these assets being sold to very bad actors who could try to continue extractive industries, who are less likely to be influenced by government and public pressure. So then we could see even the continued carbon emissions, etc. So having an orderly transition means that investors would not be left out in the rain. It means that the people who work there, who most often have very good paying union jobs, could transition to very good paying union jobs in the renewable and sustainable industries. So that's just another risk that exists within that transition. So did I say stranded assets? So yeah, stranded assets, basically.
So transition risk is one of the two big categories people talk about. The other is physical risk. Alexis, you want to say a few words about physical risk?
Sure. So
thanks.
My favorite example of this is a story about a climate scientist and a computer scientist who happened to be married. The computer scientist was making a map of the internet infrastructure in the United States and where all the broadband wires are. And they showed it to their spouse, who's a climate scientist, and their climate scientist spouse was like, oh my God, almost all of that is in flood zones. And it turns out, this was back in, I forget when, like five years ago or so, or maybe less, AT&T and CenturyLink, who both have a ton of the internet infrastructure in the United States, have a huge amount of that in flood zones. And so they wrote a paper together to talk about those risks. But physical risk is what it sounds like, right? It's Exxon Valdez, it's an oil spill, it's flooding, it's damage to infrastructure, damage to your building because of climate crises, which are here and increasing in frequency, unfortunately. It's a wildfire, it's all of the things, it's blackouts in Texas. And so there are obviously dangers for all of us collectively from that, but there are economic dangers to companies because they may have to rebuild the infrastructure after the flood. And the Federal Reserve, as a regulator who oversees banks, if banks are making loans to companies that are doing really reckless things, like putting all their infrastructure in a flood zone that they think has a high likelihood of damage, that could make the bank lose money, right? If the company goes bankrupt or if they have to take out another loan to cover all the damage. And so the Fed makes decisions all the time as a regulator when they talk to people about how they make loans. And the Fed isn't alone in this, right? Other regulators that oversee banks, like the OCC and the FDIC, do similar things. They provide information and suggestions to help them make sure that they are effectively managing their risk. And so I think part of this is we want the Fed in its regulatory role as it's going in and overseeing banks that are making loans to make sure that those banks are appropriately calculating those risks, accounting for those risks, and maybe if it's too risky, not making the loans in the first place, right? If it's very clear that they're not going to have a return on their investment because it's likely that it might go belly up. And just so that this doesn't sound abstract, if people remember in the pandemic, because of the lack of demand for oil, because everyone was quarantining and staying home, the price of oil actually went negative briefly. And the oil markets just on a whole crashed, and there's a whole bunch of reasons for that. But setting that aside, Wells Fargo had so many loans to oil and gas companies that it was either, I don't remember if it was the second quarter or the third quarter, but they had incredibly bad earnings in 2020 because they had made so many loans to oil and gas companies who had incurred all those losses. So that's not a physical risk per se, but I bring it up to illustrate the ways that this doesn't just harm all of us in the ways we're all familiar with, but it can harm the company's bottom line too.
Absolutely. Yeah, and I think the physical risk examples, right? There are. Do they have too much infrastructure in flood zones? Do they all those types of things? And then much more more complex interconnections, right? So if all of a sudden insurers don't want to insure property in flood zone, well, that's its own problem. But if insurers are, suddenly don't want to insure certain things because they're under greater climate risk, and then there's that market sort of craters, and then who's lending to them? Does it end up sort of freezing parts of a regional economy? Does it end up crashing real estate prices in a whole area? Does it end up causing a national housing crash, right? And obviously, we know, from the last housing crash that can cause massive systemic instability for the financial system. What about the banks? So, I mean, we've talked about sort of potential harm to the banks and sort of the Fed's job, and I think we're going to talk about that in more detail. I think a little bit, the Fed's job and overseeing them. But what about the bank's own role in this? I feel like we've heard some little things around the edges about that, but haven't heard anybody specifically hone in on it. Either one of you want to talk about the bank's role in financing fossil fuels and other costs?
I'll extend what Alexis just shared about the exposure on the bank's bottom line due to the negative exposure of banks' bottom lines to their massive investment in fossil fuel infrastructure in the industries. So I think, since the Paris Accord, we've seen, 3.8, the Paris Accords of 2015, we've seen $3.8 billion invested in the fossil fuel industry, which not only defies logic, it's insane. I don't even know how we have to scream this from the rooftops that continued investment in this is fueling the rise of temperatures that is leading to more intense hurricanes, tornado. I'm sorry, have you ever heard of a fire NATO? I didn't know such a thing existed until this year. We have seen European towns with biblical-esque floods. So these are things that everyone can see. Yet the banking industry loves those profits, but there will be no profits where there are no people. I don't understand why that is a difficult concept. So what can I say more about something that is very easy to see? And as long as we incentivize and we make it easy for banks to do that, then they'll continue doing it. And so, which brings us, I guess, back to the Fed. They have powers that they can exercise here, and with a chairman who has had to be prodded and pushed to even acknowledge that climate does represent an existential threat to our financial systems. Now, I can really go on Jay Powell, so I'm just going to stop right there.
We'll get to Jay Powell in a couple minutes, but let's take a few more seconds on the fossil fuel finance by the banks. In case anyone misheard, Tracy, it's $3.8 trillion that the largest banks in the world have been financing and fossil fuels and that's just since the Paris Agreement, so just the last 5 years. And it's been increasing. It was increasing every year until 2020 when COVID sort of curbed global economic activity across basically every sector. And so, I mean, to me, it seems like the lesson there, and I'm very worried now that we've lost Tracy. You're frozen. Oh, now you're back. Great. I'm great. I like that dance too. The I'm back dance. It seems to me like not only are the banks not taking seriously the climate crisis or their role in it, but quite the opposite, right? If they're financing this much in fossil fuels and growing that amount every year, all they're doing is actually increasing all those risks we just talked about, right? Both the transition risk, because they're getting deeper and deeper entangled with fossil fuels and making more and more loans, and increasing the physical risk because they're actually driving up the climate crisis, right? And so what is the Fed supposed to do about that, though? It's a bank regulator. It can't write rules that limit carbon emissions, right? So how are we? Why? Let's get back to this sort of central point. Why does the Federal Reserve matter in this?
So the Fed has a lot of different tools in its toolkit that they can use to manage any kind of risk to the economy or the financial system. So they already do stress tests for the banks, which they have to sort of go through this series of questions and scenarios and demonstrate that they would be able to withstand periods of crisis or stress or big trading losses. Another thing that the Fed does pretty regularly is it makes sort of recommendations or guidance about how much what is called capital, which you can think of as just not debt. So many companies operate and do their business almost entirely funded by debt. And capital is basically not debt. It's assets. It can be cash, but it doesn't have to be cash. It just can be things that you could turn into cash if you needed to. And so riskier things that banks do often need to have more capital. You can think of it as like a rainy day fund or a way to sort of get through stressful periods, even if they incur lots of losses. And so depending on the riskiness of the things that they're doing, they may have to have more capital. And so you could imagine that the Fed could say, you know what, we've heard from Christine Lagarde, who is the president of the European Central Bank. She has said that the markets have failed to effectively price in climate risk. We've tried it, letting the market figure it out. The market has not figured it out. We are going to try to fix that and account for that and price in the real risks, the transition risk, the physical risks, the ongoing climate risks. And we're going to acknowledge that high emission assets are particularly risky. And so maybe we will adjust the capital requirements that we want you to have for very high emission assets because of all these risks that we have talked about prior to this point. That's one thing they could do. Another thing that they could do that would maybe be the step right before that, I'm sorry, I'm doing this in the wrong order, could be a climate stress test, right? And the results of that climate stress test on their portfolio may require them to have more capital. But you could also just have them in a precautionary way, and maybe David, I feel like you should talk about this because you've written about this, is we know this is a problem. Do we really need to do more studying? Maybe we want to just get ahead of this because it's been made a priority, I think, both here in the United States by the Biden administration, but also internationally. So I know you've been asking us the questions, but David, maybe I can ask you that one if you want to talk about the sort of precautionary approach, because I think it's good idea.
Sure, thanks. So and this is certainly not, I'm not the first person to say it, just one of many, an increasing number. The the notion of a precautionary principle in dealing with climate risk in the financial system um, is a response to, I think in some ways that you could think of it as a response to the typical way of regulating the area, which is that you want enormous amounts of data and great information, and everything is based on modeling, right, and predictions and projections of what might happen, and showing that it rises above some certain threshold of risk or would deplete your capital by too much, and that is what justifies regulatory action. And the problem with using those normal methods in the climate context is that the risks are so hard to model. Right? We absolutely know that this is happening, right? We all accept the climate science, and we're headed toward utter disaster. Frankly, one way or another, because the thing we haven't really noted here about physical and transition risk is that they're actually inverse to each other. So, like, more of one is less of the other. So, right, the way we could avoid lots of transition risk is like not to make a clean energy transition, but that would be disastrous in terms of the climate and disastrous in terms of physical risk. And the best way to avoid all that physical risk and to sort of mitigate it as much as possible is to do the absolute fastest transition we possibly can, right? Which is the most dangerous to the financial system, to stability, right? So either way, we're headed for some pretty rocky territory, and we can't really predict a lot of the specifics. It's really hard to know exactly where that transition risk is going to materialize in a market panic. And it's really hard to know exactly where the next hurricane is going to strike, or when the markets are finally going to realize that coastal real estate is vastly overvalued, and suddenly there'll be a housing crisis worse than the one in 2008. But we do know it's all coming. And so we need to start acting in advance. The regulators need to start taking measures in advance to start mitigating these risks, to shore up the financial system. And the place where I was really going with this is and to start tamping down the root cause of all of it, which is the financing of fossil fuels by the financial sector. Basically, tamping down on that is what would be the sort of joint solution to both the problem of physical risk and transition risk, right at the root. So thanks for asking. I do like to talk about it. There are other tools. So I think that we've talked about stress tests. We've talked about requiring banks to hold more capital. I'd love it if we talk about a few other tools while we're on that topic, what other types of things that the Fed can do. One of the things I'll just say, since you asked, Alexis, one of the things I was focusing on in sort of my work on the precautionary principle was just making the argument that the regulators have plenty of authority just to outright limit bank activities. They have lots of different types of authority. They can do a thing called concentration limits, where they limit concentrations of certain kinds of risk. They can do portfolio limits on the types of loans that banks can have in their portfolios. And they have an ability to prohibit unsafe and unsound practices. And that actually is a really vague term intentionally by Congress, so that the regulators can use it in a really practical way, whatever's unsafe and unsound. And so part of what I was arguing is just use these authorities to actually limit the financing of fossil fuels. And again, in a sort of obvious sense, there is nothing more unsafe and unsound than driving the climate crisis, which is going to bring down the banks themselves, the banking system, and of course, the rest of us with it, unfortunately. Alexis will be right back. She needs to go get her door, I believe. But a lot of the stuff we've been talking about, aside from stress tests and scenario analysis, which are, I think, really modest, obvious steps that need to be taken. All of these things, I think, are obvious steps that need to be taken, but some of them are viewed as more sort of politically, a little more politically challenging, or the Fed, it'll be a little while before they get to them, because they need to sort of do some of their homework first. There are a few more, like there's really, really early steps they could take, particularly just integrating climate into their supervision of banks. Tracy, could you say a few words about what that means and why that's just like a modest, ordinary thing that they should be doing?
Right. This is what we've been referring to our fossil-free Fed coalition as just the low-hanging fruit. as you mentioned, David, there's existing rules, and I literally just forgot everything I was going to say because I wanted one other thing. I think somebody posed a question, so we'll come back to that. But so our low hanging fruit. Wait, David, say the question again.
Oh, I was just asking about supervision, and feel free to jump in, Alexis, or.
Oh, okay. No, I was trying to do two things at once, so sorry.
Okay, I
So,
see the question. Great question. I can't wait to get to it, but it is distracting to see them come up while you're talking.
yeah, I know. I was like, we have an audience. We love you. But as we know about some of the Fed powers, that supervision isn't literally just about um, uh, analyzing risk. It is it's really about holding those banks accountable, and as we're saying, that they demonstrate that they're actually taking meaningful steps to mitigate that risk. And so if again, if banks are doing things that are unsafe and unsound, like say lending to Joe Manchin's coal companies in West Virginia or something like that, that they shouldn't be doing that. They have the absolute power, um, granted to them by Congress, to do that. So, and I know, so we already mentioned the capital requirements and other investments. So, is there anything else I wanted to add on that? I think no. I'll stop there.
And I'll just add that the Fed has what are called supervisors, and they go in and they examine the banks regularly for all sorts of things. So they could go in and say, hey, I think you're lending too much money to risky family offices, which is something that happened earlier this year with a family office called Archegos that blew up spectacularly and cost a lot of banks a lot of money. So in their sort of regular day-to-day job, they go in and do these exams and look at their books and records and see if there's anything particularly, red flaggy, right? Like, oh, you know what, this could actually, bring you down as a bank. And so I think our hope is that they are not just focusing on, oh, you know what, you're making a loan to a hedge fund that's leveraged and it might blow up in your face, but that they're also thinking through all of the different risks that making a particular loan to, I don't know, some sort of, fracking company that's operating in the Gulf that may be subject to floods and is subject to giant fluctuations in the oil and gas marketplace, right? Like we've seen lots of volatility in the price of natural gas in the last few weeks. Those are the sorts of things that bank examiners could be looking at as they're going in and looking at banks just as part of their stuff they're already doing.
And can I add in one other thing here just to connect the past as prologue, what we learned from 2008, the economic crash, and where we had those same threats to the safety and soundness of our banks and non-bank lending institutions that were wholly overlooked and sanctioned by the Fed. We had, I don't know if people remember when Alan Greenspan said that, oh my God, what was that exact phrase? Like, our financial system is safe and sound and then it literally imploded. People losing their homes left and right, thrown to the streets like yesterday's trash. Storied institutions like Lehman Brothers and Bear Stearns gone in an instant. So the lessons that were learned from that were codified within the Dodd-Frank framework that unfortunately we have seen unraveled, particularly during the Trump administration and under Powell and Randy Quarles, who is the vice chair of supervision currently. So again, pointing to the fact that we have the tools and we also have feckless people in charge who can favor the interests of moneyed interests over people. And so literally all of us, progressive organizations are ringing that clarion call to people to understand what is happening. We have seen this before, but what we could see in the future without implementation of these rules and regs is really frightening.
So, since you brought it up, the leadership of the Federal Reserve, let's turn there. Right, given all the Fed's responsibilities on climate, and not to mention obviously everything else it needs to do, it's really important to have the right leaders in place. It sounds like I happen to know, but it also sounds like from what you just said that you're a critic of the current leadership of the Fed. And questions about Fed leadership have been really big news lately, right? For months now, particularly in the last few weeks. And President Biden not only needs to make a decision whether he's going to renominate the current chair of the Federal Reserve, Jerome Powell, or nominate someone else, but he also has up to 3 other seats to fill in the next year. So it could really reshape the Federal Reserve as an institution from the leadership level down. For anyone who doesn't know, the Federal Reserve is governed by 7 governors, sort of like a 7-member board. The chair has the most power by far, but they need to vote on lots of things, and so it also matters sort of what the overall composition of the majority is. And we got a question from an audience member that goes right into this, which is from Jennifer Powell. Probably unrelated to Jerome Powell, the chair of the Federal Reserve, but from Jennifer Powell, who says, "Do you think the Federal Reserve does not see the danger from climate, or sees it and looks away because of corporate or government influences?" Either one of you want to take that? And Jennifer Powell is clarifying that she has no relation to Jerome Powell, the chair of the Federal Reserve. Thank you, Jennifer.
I mean, I think one of the things that we can probably say historically about the Fed is that they tend to move very quickly in a moment of crisis and get extremely creative in the heat of the crisis. But when it is not a crisis moment, there is a reluctance to do that, to be creative, to stretch the bounds, to be outside of what has traditionally been done before. And there's sort of it's interesting. There's an argument that the Fed is not political, but I do think that, like just sort of observing the history of the Fed, I do think they often do act politically. Like they seem to be aware that presidents come and go, and they have the potential to dominate new leadership. And so I think that the Fed is typically concerned first and foremost with the markets defined as the stock market, the bond market. And what many of us have been trying to do is say, well, the market is far more than that. The market is small businesses. The market is, unemployment all across the board, and making sure that Black unemployment isn't higher than any other type of unemployment, right? Like the market means more than the stock market and more than the bond market. And I think that at least historically, the Fed has been very focused on rescuing the stock markets and the bond markets, and not so focused on anything else. And I think that's part of the reason that I don't think that they don't see the danger coming. I just think that the Fed moves the most, what is the word I'm looking for? Like climate change is unfortunately this like slow moving crisis that everybody knows is happening, but it's not like there's this like one instant in time, the way that the financial crisis was. And I think that is the barrier, is the Fed is good at moving fast in the heat of the moment. And it's like that story about the frog being boiled and you turn the temperature up very slowly. And so I think, which is frustrating, I'm sure, because the crisis is here, right? Like the West Coast has been on fire all summer, right? Like there's all this flooding, like people are dying in New York in basement apartments. So I feel like that's probably a very unsatisfying answer to the question, but that's my best shot.
I do think that I think that is a huge part of the story. Because there's if it were clear that the climate crisis were causing a financial meltdown right now, the Fed would jump in, right? they would stop it. They always they do that. And I think that the real challenge is, and this is part of where the precautionary principle comes in, is persuading them that they need to act with that level of urgency right now to prevent harms that aren't going to happen, that aren't happening quite yet. But now is the time to act, right? There's no time left on that clock. And that is just completely out of step. I mean, it's out of step with human nature, right? That's out of step with that underlies a lot of our policy problems in the climate space and our inaction. But certainly for financial regulators and certainly for the Fed, that's part of the picture. I'll relay a story. I was having a conversation with actually a high-level official in one of the Federal Reserve banks over the summer in July, and he started the conversation as a lot of the regulators do, which is this is a different problem, which is saying, climate change isn't really our responsibility. It's it's supposed to be the other government agencies. It's not really our job, and which to a point is true. It's not their job to primarily be mitigating carbon emissions just because they're trying to save our habitable environment or save nature or something like that. It's their job to protect the banks and the financial system, which also involves acting on carbon emissions. But within about a half an hour conversation, he was willing to say, yeah, I guess you're right. If we had a model that showed us that the banks are doing something now that would destroy them in 2050, and they had to be stopped now to make it not happen, I guess we'd stop them, yeah. But no one's built that model, right? And no one's that's it's impossible to do to show that with respect to any individual bank that it's doing something right now that is going to destroy that bank by 2050. So that those are a lot of the challenges, I think. But there is this general. Sorry, go ahead.
Oh, I was just going to say, and this is not a problem unique to the Fed, right? I think many major financial market actors are very short-termist in their thinking. I think the difference between those actors, which are like your sort of typical Wall Street actors, is they're short-termist because they are focused on things like executive compensation, bonuses, right? They're worried about what are they going to get paid at the end of the year, and it doesn't really matter what happens the following year because who knows, maybe they'll change jobs. And the Fed is supposed to have this like public-facing mission to preserve all of us, and so I think that's one of the challenges that we sort of all collectively have, is to disentangle this sort of short-term thinking that you typically do see in many of the private market actors from the policy making of our public. And I realize the Fed is a sort of public-private mix, but they have a very clear public mission that obviously like a private firm on Wall Street doesn't.
So it seems like getting them to take more seriously that public-facing mission and act on climate. It's like Tracy wants to say something maybe to my question, which is that takes better leadership, right? So what's going on with the debate over Fed leadership?
Thank you so much for asking, David. Really pulling that thread from from Alexis's comment on that short-term, long-term thinking is a perfect framework for thinking of Powell's thinking on climate risks and Lael Brainerd's thinking on climate risks. He is up until, I don't know, last week, been deeply reluctant to acknowledge climate risk at all. In fact, oh gosh, I can't remember who did the analysis that during the Trump era that Powell did not mention the word climate at all for 4 years. He only joined the national. Oh my gosh, I always forget the whole title. The National Greening Foundation.
It's 3:00.
Oh, sorry. That's my Mac.
You're talking about the Network for Greening the Financial System?
Thank you. Oh my God, literally, I always forget that. Didn't join until December 2020. The European central banks, other central banks around the world have been part of it. Only after President Biden was elected did he do that, when it was pretty clear that the Trump objections would hold sway on the courts. So even earlier this year at the Green Swan conference, he still, he constantly has to be pushed Brainerd this week just gave an amazing.
Who is Brainerd? Who are we talking
Oh,
about?
sorry, Lael Brainerd. Why, thank you, David, for asking. Lael Brainerd is currently a member of the Federal Reserve Board of Governors, and she is the person who many progressive orgs would like to see become the chair of the Federal Reserve. And historically, in comparison to Powell, she has been on the right side of issues related to climate and climate risk. And just this week, she gave a wonderful speech about that, and I'll find the link to put in the chat. And Jerome Powell could never give a speech like that because he doesn't believe in it. He does not even come from a place of thinking about that. He is a former Carlyle Group leader. Private equity is the center of his being. So
Powell does have some defenders, even on the left, right? So.
Oh yeah, there's some FinReg bros who embrace him. But the thing
is complicate things a little bit, right? It's like a lot of people actually do think that Powell has done some things right.
But what he's done right is the things that should have been done. So if the argument is that, oh, Jerome Powell, our great savior, made these intelligent steps to protect our economy during a incredible global health crisis, the options were really to do what he did. So the idea that no one else could replicate what should be done no matter what is a specious argument at best. And also it's a gendered and misogynistic view that only Jerome Powell could have made these choices and done the right thing. And the other argument, you don't change horses in the middle of the water. Well, you know what? I don't change horses in the middle of the water, but I certainly would choose, if I were the president of the United States and a Democrat, that I would choose to have a Federal Reserve that could help implement more progressive ideas and ideals across our fiscal and monetary policies that could stay in place for the next 20 years instead of locking in the worst and far right ideas and ideals in that system.
Yeah, I mean, it is another dynamic with the Powell question that if he is renominated and stays, then there's another governor who has the choice to stay, who might decide to stay, and then there will actually be a Republican majority on the Federal Reserve until, I believe, it's the last year of Biden's second term. So basically, you suddenly would have a Republican majority for basically Biden's entire presidency, which I'm not sure exactly why he would want to take that chance. And yeah, I mean, in addition to Powell is praised for his response to COVID. He's also praised for doing good things on monetary policy, for being less worried about inflation and caring more about unemployment than we've seen, I guess, basically ever from the Federal Reserve since it's been tasked with those missions. But as you pointed out, Lael Brainerd is actually as good or better on everything, right? So just as good on monetary policy, arguably better on monetary policy, and better on climate, better on regulation. Powell has not been very interested in regulating Wall Street at all. In fact, has been quite interested in deregulating it. And in fact, right, just 2 days ago, Lael Brainerd gave a fantastic speech about climate-related risk and what the next steps that the Fed needs to be taking, and sort of said all the right, obvious, practical next steps that the agency ought to be taking. It's way behind its peers globally. Those aren't the only two people being discussed, and those aren't the chair isn't the only position. Alexis, do you want to talk a little bit about who else should be nominated to the Fed and why, these other open seats?
Sure. So So Randy Quarles has been mentioned. He is currently what is called the vice chair of supervision and has a particular role overseeing financial regulation from the Fed's perch. There is also an open seat on the board. This is one that was in the Trump administration. They tried to give to somebody named Judy Shelton, and she failed to get the sort of support she needed, and so that seat has been sitting open since the end of the Trump administration. So that's the other seat that people tend to talk about. But there's also Clarida, who is another Fed Board of Governors. He's actually been in the news lately because of some of the insider trading concerns. But so I think, there may actually be 3 seats depending on how it all shakes out. But let's like conservative, maybe there's 2. I think it's really critical to have a very strong consumer protection focused, financial regulatory focused person in the vice chair of supervision seat. The reason for that, if we want to sort of like look back to what's happened in the last couple of years, there's actually a really great report that Better Markets put out that sort of examined some of the deregulation that has happened at the Fed since 2018. And I'm not going to name all of them, but just to name a few. So we've been talking about capital requirements in this discussion. One of the things, unfortunately, that they have done is weakened capital requirements that are associated with stress test. Another thing that they have done is weakened something called the Volcker Rule, which is a rule that came about after the financial crisis that's meant to curb big banks' ability to basically gamble with their own money for their own account, do what's called proprietary trading. That has been drastically weakened with Randy Quarles as vice chair of supervision and with under Chair Powell at the Fed. So if we were to reverse this, I think, there have been many different names reported, but 2 that come up pretty consistently in the press is Lisa Cook, who is an economist at Michigan. She is incredibly accomplished. She speaks at the Fed regularly. One thing we haven't mentioned yet today, that's one of my favorite things that the regional Feds have done. So there's the sort of Fed board here in DC, but then there are 12 regional banks all across the country. And Lisa Cook has spoken at this Racism in the Economy series that the 12 regional banks have been doing for the last year. And she is an expert in this issue. She's studied it extensively in her work as an economist and has been an advisor to many important reports about it. And she is somebody that has, according to reports, a lot of support and I think could be a really key voice on the board. Another person whose name has been reported a lot is Sarah Bloom Raskin, who used to be on the Federal Reserve Board during the Obama administration and then was the Deputy Treasury Secretary also during the Obama administration, and before that, was a sort of the head of the Maryland, I'm blanking on the official title, David, maybe as a Marylander, the consumer protection person in Maryland, and was just sort of seen as a very leading expert on financial regulation, on making sure that we don't repeat the mistakes of the financial crisis, because when she was, in Maryland in that regulatory role, she sort of saw it coming. And so I think those 2 additions to the board could really shift the direction of the entire board, regardless really of who the chair is, because you really want to have a focus not just on monetary policy. You have to complement it with financial regulation and protecting the economy from that perspective, because monetary policy can only do so much in the middle of a financial crisis. And I think we learned that lesson the hard way in 2008, and I really hope we don't have to learn it again the hard way all over again. And so I think the addition of people like that could really help sort of unwind some of the things that I mentioned, some of the bad things that have already happened, but also work towards making policies that are affirmatively good to help make sure the Fed is fulfilling its mission of protecting financial stability when it comes to everything, not just climate risk.
I couldn't agree more about the importance of those other roles and those 2, the great credentials of those 2 individuals. I do worry a little bit that if we were only to get those nominations and if Powell remained in the chair, that the chair has enough power that we just wouldn't see nearly enough progress, right? Certainly a better world, I think, if Powell's also replaced. There's a lot of talk that the chair has so much power that other people wouldn't be able to get much of anything done. I don't know specifically. It might depend on what like everything in Washington, depends on individuals' personalities, their drives, their ability to get things done. But yeah, hopefully we can really turn things around at the Fed, both on climate and on financial regulation generally, which has just been heading completely the wrong direction. There's one more really important topic in this area that we haven't gotten to, which is a new bill that was just introduced into Congress a couple of weeks ago called the Fossil Free Finance Act. And it was introduced by Representative Mondaire Jones, who was actually going to be on this panel and had to cancel kind of late in the process, unfortunately. And also Representatives Rashida Tlaib and Ayanna Pressley. And it's also the case that advocates are talking to folks in the Senate, and it's looking like Senator Markey, for one, is going to introduce it there, and possibly with some other senators. So this is a really new idea. A lot of like bringing together a lot of the concepts that we've been talking to today, and kind of the apogee, I think, of like what we could want from the Fed. Tracy, would you walk us through really quickly what that bill does?
Lightning round. All right, 5 minutes to go. So this is a
4 actually. So sorry.
Oh, sorry, 4. Right. Okay. Let's see if I can do it. Okay. So this bill is pretty groundbreaking, but also it makes sense, and it has been done. Something like this has been done before. I think, as I mentioned earlier, around the Community Reinvestment Act, Congress has power to expand or limit the mandate of the Fed. So here, Congress wants the Fed to use its existing regulatory authority to protect individual banks from, and also our overall financial system that the Fed oversees from the risks that, as we've been mentioning, that the Fed has the power to protect and instruct these banks to limit their risks that would be caused by further investment in fossil fuel infrastructure. What else can I tell you? You know what? One, I just want to tell our listeners, please, look this bill up. It's short, sweet, it's great. You can understand it. It makes sense. And one other thing I want to add here. So the way the Fed would accomplish this is by requiring the largest banks that have more than 50 billion in assets to submit and follow a plan for achieving zero financed emissions by 2050. And that key target helps protect people from the devastating impacts of the climate crisis.
Huh.
That's
so a lot of the big banks have already made these commitments. They said they want to do net zero by 2050 or whatnot. But this is a bill that would say to the Federal Reserve, you need to require the banks to write a plan and submit it to you to show how they're actually going to do it. That's right?
I muted myself. Yes, that is correct. And again, this is a kind of low-hanging fruit that it is very possible for the Fed to implement this, and this will help usher in the host of other good things that can happen. And it doesn't leave it to the individual banks to make decisions about this anymore, because that can't happen, because we see with the 3.8 trillion investment over the last years by major banks that loan devices, they simply will not do it. So let's use the power that we have to make that happen. So I know we're running low on time, so David, I'll shut up.
Sure. One thing I'd add, the bill also doesn't just require the banks to make targets for 2050. It also requires targets sooner, right? We hear a lot of this talk about we'll do X, Y, and Z by 2050, and it just sounds like a lot of excuse making, right? Just kicking the can down the road. In fact, a bank executive, I think, was recently quoted as saying that everyone's happy to make those announcements because it's not their problem. It's not even their successor's problem. It's like their successor's problem, how to meet that target. So this bill does actually require 50% reductions by 2030 to make sure that we're actually on track. Alexis, Tracy, is there anything else you want to talk about? And if not, last words, let people know where they can find you.
We probably don't have time to talk about it, but I'll just say that one thing for everyone to think about is the Fed has a lot of powers in an emergency. And last year they did a lot to rescue the bond market and did some things to try to rescue Main Street, but it didn't work, I think, as well as the bond market rescue. So one thing for all of us to think about is, are there conditions we want in place for the next time? Because unfortunately, I mean, hopefully there won't be any more crises, but as Tracy said before, if past is prologue, there probably will be. So that's a good thing for everybody to think about, right? Let's have a plan so we're not trying to figure this out in the heat of the moment in a crisis. That's the only thing I'll add. And I am at Open Markets Institute, which you can check us out. We are openmarketsinstitute.org.
Everything Alexis said. And I would urge our listeners here today to reach out to their senators to support the nominations when they do occur, for Lisa Cook and Sarah Bloom Raskin as vice chair of supervision and vice chair of the board. You can reach out to them now, though, and tell them that's what we want to see, progressives and people who care about the way the financial system impacts individuals and not moneyed interests. And you can find me at tlewis, Lewis, at citizen.org. I welcome inquiries and love to talk about this stuff because I am a straight up climate finance nerd.
You can also find a lot of good work on this at Roosevelt Institute and also at Public Citizen, citizen.org/climate. Thanks very much both to Tracy Lewis and to Alexis Goldstein. It's been a great panel.
Thanks to you, David. Thanks everybody for joining us.
Yes, thank you, David, for doing this. And thank you, Alexis. This was wonderful. And thank you to Zoe, who was our Netroots host, and good luck in law school.
Thank you, Zoe.